Looking to sharpen your investment skills, gain exclusive market insights, or discover what it takes to thrive as a registered investment advisor? Feeling like you need that extra edge to stand out? That changes here, today. Welcome to the Intelligent Investor Podcast, RIA Insights. I'm your host, Shannon Robnett, and this is the podcast where you learn from the best and brightest in the industry. From insider stories to expert strategies, this show is designed to equip you with the knowledge and confidence to grow your practice and make smarter investment decisions. Let's dive in.
Hey everybody, welcome back to the Intelligent Investor RIA edition. Today we are talking to Nader Panahpour, and he has a unique business model that I'm going to let him describe a little bit more. But the reality is, what we try to do on this podcast, as you all know, is we try to give you other insights. You know, the world of investment isn't just about one thing. You hear people all the time, Grant Cardone is really, his main voice is about investing in real estate. You hear, people like Warren Buffett, their main thrust is investing in the stock market. What we're trying to do with this platform is to give you other insights. And that's really why I reached out to my friend Nader, is because we wanted to give you the ability to see other places to invest, why they're there, and what you may be able to do to supplement or augment some of your other investments that can create cash flow, tax benefits, and long-term legacy wealth, which is really the goal here, is to create a portfolio that does all of those things in somewhat of a balance. So again, guys, let's welcome Nader to the show. Nader, tell us a little bit about yourself, how you got to where you're at in life, what your road was there. Take a couple minutes and just introduce us.
Hi, Shannon. Well, thanks very much for having me on. This is really terrific. You guys have a great product, and I'm very happy to be here. I was born in the Middle East, and we moved to the States when I was a baby. I did all my studying here in America, and in the sort of 2000, 2010, 2011 timeframe, I started buying payment processing businesses here in the States, and a payment processing business sort of acts as the bridge between merchants and Visa and MasterCard. And those businesses provide pretty stable cash flows on a monthly basis. So I started buying those businesses, and along the way, cash advance companies, and those are companies that provide cash advances to small and medium-sized businesses, they approached me to offer their services to my merchants, and they offered me the ability to buy the paper that they generate when they create a cash advance to merchants like mine. So in about 2011, 2012, I started allowing advance companies to market to my merchants. And I started testing the water and purchasing this paper that we're talking about, the short-term paper that is generated by the cash advance companies. And so from 2012 to today, I've been acquiring this paper from various different funders around the country. I now have a hedge fund that does it. In the past, I was doing it with just my money and my friends and my family's money. And we grew it to having managed accounts. And now we have a hedge fund that actually does this, with a third-party administrator and, a partnership.
So really, you've been grassroots in this from the beginning. I mean, and for those of our listeners that don't quite understand this, I had the unfortunate experience of owning a restaurant at one point. But, when you're dealing with credit cards, you're settling out every night and you're paying, your credit card processing fee, and you're getting the balance in your bank account. And typically especially the restaurant business, it is a cash pay as you go business. So if you want, most people in the restaurant business, unless you're a chain or things like that, you don't have accounts that are going to give you 30-day terms or 60-day terms or things like that. And so you're always managing that cash flow. You had a really good Friday night and a really good Saturday night, but Monday is kind of slow. Tuesday's not great. You've got to get your stock up for Wednesday, Thursday, Friday again. Those can be problems. When you talk about, you mentioned several things there that I'm going to have you define for us. You mentioned a hedge fund. You mentioned paper, buying the paper. I want you to walk me through the process of what does it mean for a company like yours to be working with a hedge fund?
So we are a hedge fund, and so we have the ability to take in limited partners that can come and invest, virtually any amount of money, any small amount or large amount of money into our fund. We have a third-party administrator, a company called NAB, that handles, I want to say, 2,000 to 3,000 hedge funds around the world, some of the largest ones. They look at all of our numbers on a weekly basis or monthly basis, and then they will send the investors the statements to see how they did on their investments. So it's all handled by a third party. And what I go out and do is go and find, you were referring to your restaurant and your cash flow issue. That's sort of exactly, restaurants are exactly the kind of businesses that we offer these cash advances to. And then we can get into the paper and how it performs, in a second.
And so when people think about cash advances, they immediately go to payday loans, right? And that whole business model, that's not what you're doing. That's not what you're dealing with. You're not doing title loans, that kind of thing. But there is a need. If you are an emerging restaurant, or, it's very popular in trucking with factory. But one of the things that happens is you want to expand. You've had a great, this is your second year in business. Banks like to see 2 years of tax returns. You're just starting your second year in business. You're doing better than you thought. You need to expand your patio area, but you can't get funding because you don't have 2 years of tax returns. This is where coming into a cash advance company can be very beneficial. But instead of just focusing on the cash advance side, let's talk about the business that you've built beyond that. So when I'm looking for an investment and I'm coming to you and I've got $100,000 that I'd like to invest, what is your typical process? And when you're talking about buying paper, explain to me how my investment goes into that process.
So let me start from let's go to your restaurant example. You have a restaurant and you're looking for $100,000 to expand your patio and, for more stock. You apply for a cash advance. The cash advance company that you decide to go with offers you that $100,000. They typically can get you the money in 48 to 72 hours, which obviously a bank could never do. And the example that you gave, Stan, is exactly right. Most of particularly upcoming restaurants can't even go to banks, and most people for these sums of money, whether it's $50,000 or $150,000 or anything in between, banks typically don't even give those size loans. They go to an advance company, and you get your money in 72 hours, and it's based on your business's credit card receivables and your general receivables. And so let's say your company is approved for that amount, that the cash advance company will send you the $100K. You'll agree to pay back $120 to $130K in a certain amount of time, depending on which version you choose. And then that cash advance company will go on and sell that paper, at $100,000 of paper, to companies like myself. And we can buy slices of that paper, or we can buy all of the paper.
And then it comes into your company. You slice that up. You bring in 10, 15, 18 different investors to that $100,000 note. So no one person has total exposure to that. But the beauty of this, Nader, is that when you're doing that, you're getting paid back daily, weekly. You're getting payments.
That's exactly right. I think one of the things that really attracted me to this was before I had a hedge fund, I needed cash flow, and I needed active cash flow on a weekly basis. And what cash advances do, they amortize either, like you said, daily or weekly. And so to the example that we just gave, our $100,000 piece of paper is being paid back, $1,300 a day, for example, for 100 business days. So every single business day, the cash advance company is pulling that money from your account. We're not chasing you for a check. We're not asking for a wire transfer. They're pulling it out of your account, and they come up with a formula that you can afford. It's usually 15 to 20% of your daily receivable amount that they take out. And so then we, as the investor, we get very steady, very predictable cash flow from 3 days out. Once we buy your paper, 2 or 3 business days after we buy it, cash flow starts coming in.
So let's talk about this. So the actual company that sold the paper, that did the underwriting, you've got relationships with them. You're buying their paper often, so you understand how their business functions. They're selling this $100,000 advance. Are you paying $100,000 for that, or are you getting a discount, or are they getting a premium? How does that really work?
So typically they maintain at least 30 to 40% of it themselves. So they have skin in the game at all times. And I'm buying it at par. So I'm buying it at exactly the same price. And I pay them a management fee. So I pay them a servicing or management fee, however you want to call it, the service and managing account, because oftentimes that same person, in our example, your restaurant, will ask for another advance. When you've paid off 50, 60, 80% of it, oftentimes you might go back and say, I need, we've got 4th of July coming up. We need to really stock up. It's a big weekend. We need money. We need goods. And you go back to that company, and then the company comes, offers it back to people like me, Shannon's restaurant. Remember, we just did one for 100. You need 60. And again, I would go back and buy, half of it, or 40%, 50%, 60% of it. The funder will keep, like I said, 30 to 40% of it and charge us a management or service.
So when we really look at, let's look at the end result. I'm the investor. Now we want to switch to the other end of the equation. I'm coming to you, and you have 10 $100,000 notes that you have bought 50% of, or it would be 20. We're going to use the example of 20. We got 20 $100,000 notes that you have bought $1 million aggregated, and I would come in as one of a slice of that as well. So what we're continuing to do is you're continuing to mitigate risk all the way down the line. What does that look like when you look at, because we all have, I do a lot with apartments, we have this category for bad debt. We know that you're not always going to win in these scenarios, and there's going to be issues. What is your batting average on that? What portion of debt do you figure into that?
In this space, it's not a default rate, it's a collection rate or collection curve. And the reason is, back to your restaurant example, if you owed $130,000 and you paid back $105,000, it didn't default. You didn't pay the entire amount back, but we got our principal plus a tiny bit. So we typically, we underwrite for up to 20% in 80% collection rate. So 20%, it's not a default rate, but an 80% collection rate. But we're closer to 8 or 9% of a default rate, or a 92% collection rate.
Yeah, you're the same. You're about where we're at. We have about 4%, 5% in multifamily that we figure is a bad debt rate of what we see. We know we've got skips. We know we've got damage that's not going to be covered. We've got all different kinds of things that add up to about 4% of the net revenue of the apartment. And so you're not that much different. And then you're continuing to diversify. See, when I go in to do an apartment complex, I'm millions of dollars into one asset. I have not all of my eggs in one basket, but I also diversify across several different projects. But we have a lot of money tied up in that one asset. And there is that same thing that we do in our syndicated model, where we involve multiple investors, and typically investors are involved in multiple projects because this is just a different avenue. Now, from what I can deduce from the business model, there's not a lot of tax advantages behind this because we're loaning cash, but it is a passive income to me, or an inactive income. It's not an active income to me, but it is revenue that is coming in. Now, when I'm looking at it from my point of view, it sounds like you are buying the paper. The servicer, the original paper writer, is getting paid daily or weekly. Are you getting paid daily or weekly? Are the investors getting paid daily or weekly?
Yes, we are getting paid daily or weekly. And we typically choose to relend that money daily or weekly. And that's how you get a compounding effect.
Okay, so this is very interesting. So I put $100,000 with you. You've dispersed that over 20 pieces of paper, 20 instruments in your business. And each week, I'm going to get 5% of that paper come back into your company from my slice, which you're going to relend, and I'm going to get dividend payments. How often?
That depends on the investor. Most investors choose to let it roll, because if you let it roll, the money can turn anywhere between 3 to 4 times in a year. And that's how you end up with the best returns. There are some investors that would like a quarterly something, a stipend, or even at the end of the year, they let it roll, but then they'll take out, anywhere from 8 or 15%, depending on what their tolerance is, what they're looking for. But they will actually let it roll for the entire year. And then at the end of the year, take out, a percentage of money that they can, that they're quite comfortable with. So it's, the issue is that the money comes in so fast. You don't hear that too often with loans and with business, but the money comes in very fast. So, everybody's a little bit different in how they like to get their dividends.
When you're looking at paper and you're looking at these loans to buy, what is the typical repayment period? If you were to, you've got some on the long end, some on the really short end, what is your typical range on that?
Somewhere between 6 and 8 months.
Okay.
Right around 7 months.
So if I'm looking at 7-month paper that's $100,000, I could do some easy math there. We're going to get about $12,000 a month back, roughly, that we can either distribute to the investor again. We can so you have a lot. You've got $5,000 a month coming back in on that $100,000 that you loaned out, and we were talking about $1 million. So you've got somewhere between 80 and 120 on a weekly basis that you can do something with to compound that effect. When you're doing that, you're really maximizing what happens. What does that kind of return look like for the investor if they were to let it roll for the year period?
So obviously, future results don't,
Thank you for that disclaimer.
You can never say the future is anything like the past in our business, but our investors are averaging somewhere between 2 and 2.5% net of fees per month. So somewhere in the
getting
20s,
close to 30% annually.
Somewhere in there. And, I don't want to make any promises, but something like that. Yeah.
We can see this is a much higher rate of return with, let's just say, a lot more risk, because while the capital is at risk, you have 100% of the capital at risk in the first months. And if you continue to roll it, I guess technically you do have that capital reinvested, so it is back at risk. But at the end of that time, that is producing a result that is 6 times what your average real estate deal is producing. If you're doing 4 to 5% annual on your first year in real estate, you're doing pretty good on the cash flow side. And obviously for the audience, this is not something you would typically see an investor do with every bit of their money, right? This is not going to be their main source, because again, if you guys are following the intelligent investor strategy, you've got to have something in your portfolio that's wanting to help you offset these taxes. Because the reality is, if Nader's producing you a 30% return and you've got $100,000, you're going to receive $30,000 in income at the end of the year. But you're looking for that multiplier, because this is an even 1-to-1. You've invested $100,000, you're going to get a return on that money. Where with real estate, you're able to use your leverage. So as we know, if you're investing $100,000 in real estate, you're usually going to be able to get a 3-to-1 or a 4-to-1 on that and be able to purchase a $400,000 asset. That is going to be able to provide you with depreciation that is going to probably give you enough in year 1 to come very close to offsetting gains that would be provided by a company. But when you do that, you're now creating this portfolio. And this is exactly what I wanted to talk with you about it, because this is not your only investment vehicle that you use. You use other forms of investments as well in your portfolio. Tell us a little bit more about some of those.
So, I've done some syndicate investing in multifamily, similar to what you guys have done. I've owned gas stations with the real estate, because gas stations also provide good tax treatment. I've invested in other funds. I think you're exactly right in how you explain it to your listeners, and that I like to have as many different pools generating some or less, some or more of income, but then also you need some depreciation and you need some favorable tax treatment to offset some of your gains. And what I do is almost the opposite of what your real estate investors have. And that's why we have quite a few real estate investors. What I do generates income tax. And so I do need the depreciation. I've purchased gas stations and I've purchased multifamily, like you're saying, because I'm on the other side of the spectrum. I do need some shielding.
Well, and Nader, we often hear people say, well, I'm diversified because I'm in 5 syndications. I don't think that's the diversification that you and I truly believe in. Diversification is also diversifying asset types, having some things that are strong cash flow, having some things that are depreciation in the beginning, but truly wealth building at the end. If we look at your business, it rolls over every single year. And you're at bat again. Every single contract that you buy, you're back at ground zero. Where with real estate, and I use the example of my parents often, what they were getting for rents in 2001, it was 45 cents a foot that is now $1.25. Their return on investment on an annualized basis today is substantial compared to their actual investment. And that's what the value that you get with real estate. But it took 20 years to get there. When we look at your investment has a high yield that is available literally day one because you're getting cash flow paid back very, very regularly and on a very tight schedule. So you're in a situation that you're generating higher returns. But again, you're kind of at ground zero every day. You're creating income tax every day for yourself. And so augmenting and stepping into other areas that provide that is really what you and I are talking about when we talk about diversification. It's using different assets to do different things instead of going, I'm all in on real estate, I'm all in on a hedge fund, or I'm all in on the stock market, really being diversified so that you can come up with a really good mix to maximize your cash flow, maximize your wealth building, and maximize the tax benefits that come along with that, because that's what's going to create a balance for you. Because if we look at just a cash flow situation from what your business creates, you're going to receive up to, we'll insert the disclaimer here, right? Past results do not indicate future performance, but you're going to receive it up to a $30,000 benefit at the end of the year. Of that, you're going to step up, and Uncle Sam's going to say, oh, excuse me, don't forget about me. I'd like $6,000 to $8,000 of that for myself. Where when you're able to balance that with real estate and maybe put $50,000 into the purchase of a single family home, take the depreciation on that, offset your income. At the end of the year, you're not going to receive $30,000, but you're going to receive possibly 15 plus the growth of the asset on the real estate side and the tax benefit that is going to allow you to keep the majority of that $15,000 and not be in a tax situation. And as we know, Nader, that your tax bracket is very close to your return. If you can up your 30% return by another 20% by providing a tax benefit for yourself, you're doing better, right? And that's really what true diversification is. And so when we look at these kinds of combinations, your business is a really fantastic way for people to use some of their excess cash. Especially a lot of my investors are high net worth individuals, and they're stepping into a situation where most of the syndicated funds that I do have $50,000 or $100,000 minimums. If someone was doing something where they had $10,000 a month in excess cash flow, would that be something that they could place with your company on an ongoing basis so that they always have money working with you, but then on an annual basis are able to harvest some of that out and continue to have kind of an elevator effect where they're continuing to bring money into your company, continuing to take money out of your company so that then make the future investments where it's growing while it's compounding from their additional efforts of additional cash flow?
Yes, yes, absolutely. If we had clients looking to do, what you just described, sort of the elevator effect of putting in on a monthly basis, we would be very grateful, very happy about that. Sure.
Yeah. And so, guys, you can see how by stepping outside of one funnel, one vertical of I am all in on this, you can not only provide some diversification for your portfolio, but can supercharge some of your returns that would allow you the opportunity to have the benefit of what's going on. Because at the end of the day, you've received your funds back. And now let's kind of put this in a little bit bigger perspective. Nader, we've been talking about, I have $100,000 to invest. You've combine me with, we'll say, 10 other investors. So you have $1 million to invest. But inside your hedge fund, what kind of volume are you really working with on a monthly basis to place in new contracts?
So I think last month we did a little under $16 million worth of contracts.
16?
Yeah, that's right.
$16 million. On one hand, you're buying $16 million in contracts every month. And on the other hand, you're seeing $16 million in contracts mature. You have a very high liquidity in your business, whereas real estate does not provide very good liquidity, especially in the first 5 years, right? There's money that's made, but then there's the real estate fees that have to go in there. There's the commissions that have to be paid. There's the title insurance that's got to be taken care of. All of those kinds of things make real estate pretty illiquid in that first 3 to 5 years that can be offset with something like yours because you're seeing a churn in your business that I'm going to be tied to you if I say, hey, I want to go the full term of these contracts. I'm going to be tied to you for 6 to 9 months. On the other side of that, if I decide that I want an annualized basis, I could do that. But the reality is you're seeing churn in your business constantly with $16 million being placed every single month. That's pretty phenomenal. Now, I'm going to ask you a question. How much did that grow over the last 12 months? What were you doing in February of 24 versus February of 25?
So it's been a steady growth. We probably did 12, 15% last year, same sort of time. And so it's been a sort of a steady growth ever since COVID. It's been pretty steady.
So, when you're looking at that, you're constantly looking for new capital and you're constantly deploying that with some old capital. People that have been with you for 4, 5, 8 years. And so you're blending all of this together. This is why I think it's so important that you have eliminated the headache for yourself by involving a third party that is tracking all those numbers. That's their specialty. If I remember, you said they're doing this for about 200 other companies like yours.
So they're doing it for, I want to say, about 2,500. They're named, they're called NAV, N-A-V, and they're one of the foremost third-party administrators of some of the largest funds, hedge funds on the planet. And so they handle all the numbers. They're third parties. So they handle everything.
So you're working with first-class people that are contacting the end user. You're being selective on the paper that you're purchasing, the contracts that you're buying, because it's fitting in your buy box. You've reduced that down to a single-digit number on where you're seeing bleed off or default or collections, whatever you call it. And then you're outsourcing the other headache. I'm starting to see the genius of your business operation here, my friend. You've got it to the point that the accounting side of it isn't yours as well. You've got a third party. So it's even one step cleaner because the third party, they're not going to cover for you. They're going to just report the numbers in this instance that there happened to be something going on. So we're going to get real-time reporting. And the thing that you're looking at is you're looking at something that has been a part of making our economy go around for a long, long time. And when you guys really think about this, the interest rates that are being charged to small businesses, even larger businesses, aren't that out of line with where credit cards are at. I'm going to ask you another question, Nader. What is one of the largest contracts you have purchased in your career?
So hospitals tend to be big users of cash advances because they're constantly
hospitals.
Because they're constantly waiting for their insurance money. So there are companies that specialize in very large advances, and hospitals, will ask for $8 or $9 million for the period of 3 weeks or for a month and a half. And we've participated in some of those.
So, guys, I asked that question so that you can get a glimpse of who's using it. We use the example of a restaurant. Restaurants come and go. You don't see a lot of hospitals coming and going, right? But this is cash management. This is in the hospital's best interest because they are able to, in a very effective way, get their hands on a large amount of cash. We all know, we've all worked with insurance companies, whether it's from an auto accident or seeing our claim paid. This is not a fast process. So we're able to speed up that process, take care of some things inside our daily operation that is a cost that we're passing on to the customer, whether that's in the cost of the meal, whether it's in the cost of the service. What are some of the other industries that you see are very common that would probably surprise most people?
So I think construction is pretty common. We already touched on the restaurants and the bars. Hospitals are pretty common. The trucking companies are very common. You have large sort of sales groups, sort of medical insurance and insurance sales offices that they're waiting, a couple months for their sales checks. The entire office will do a cash advance to get their money straight away. And then they will give the office's sales revenue for the month or the quarter to the advance company, less a fee. So really, most businesses use a version of this.
One of the other ones that I know does this, and I don't know if you're involved with this particular industry, but people that are in the online sales business, from the coaching or the, course creation, you see they create a course and they say, hey, course is $3,000 or it's 10 payments of $400. That is them coming out of there and saying, hey, I'm going to sell this paper for the additional $100. I'm going to get a contract where I can get my $3,000 now, and Nader's company can collect that over the next 10 months or whatever happens there. And a lot of that stuff that we don't even see is in our economy is being handled this way. When we look at, again, guys, what we're trying to do is we're trying to bring you insight on how to bring additional value to your portfolios without having to just kind of put that into a Vanguard fund, because these are ways that you can take full advantage of reaching out to companies like Nader's to be able to create additional streams of income with additional amounts of cash that you have in your control at the time. And so when we look at how those things go together, this is a very, very viable option. Nader, one thing that you haven't done yet is you haven't mentioned the name of your company and how people can get in contact with you.
So we are called Tecumseh Alternative Asset Managers. Visit our website, or I can give my, our numbers, our emails.
We'll put all that in the show notes, so people will be able to get to your website. But I just wanted you to tell us what that is. And guys, I want you to think about the ways that you could do this. If you're a new investor or if you've not explored this, go to the show notes, grab that contact, get a hold of my friend Nader, talk to him about what's happening, what he's got, what opportunities are in front of you, because I think this is a very, very viable option for you, because it's one of the ways that you can manage your cash better. It's one of the ways that you can provide very strong short-term returns that can leverage you into other places. It's something that you can use after you've created a large nest egg or on your way to creating that nest egg. And it really does play well. And so I want to thank you very much for coming on the show, for giving insight to our listeners on other alternatives that are out there for people to make solid investments that are tried and true, used by all kinds of people, providing all kinds of services in a very diversified way that allows them to make intelligent investor decisions that really boost their cash flow. So thanks again, Nader, for joining us on the show.
Well, thanks so much for having me, Shannon. This has been a lot of fun.
So guys, when you're looking at what you can do with your portfolio, it's never ever a bad idea to explore new opportunities, to take the intelligent investor framework, to move that into what you're looking at next, apply that to it and see how it works. And always make sure that you're balancing things, that you're taking in additional insight, you're talking to professionals, and you're always working with verified, bona fide, researched, and vetted professionals that have been in the industry for a long time, like Nader has been and has that track record, has that oversight, and has those things in his business. Thank you for tuning into this episode of the Intelligent Investor, Registered Investment Advisor, Other Alternative Asset Division, where you can get insight just like this. So if you guys would like and subscribe to the channel, and make sure you come back here for more content, more information. We'll talk to you soon.
You've just listened to another episode of the Intelligent Investor Podcast, RIA Insights, the show where we bring you actionable advice and inspiring stories straight from the top minds in the industry. If you enjoyed this episode, be sure to subscribe on our podcast channel, share it with your network, and leave a review. For even more insights and resources, connect with me on Facebook, Instagram, and LinkedIn. Remember, the road to success starts with the right knowledge, the right strategy, and the right people by your side. Thanks for joining me, and I'll see you next time on the Intelligent Investor Podcast, RIA Insights.